A welcome pause in the RBA tightening cycle as expected, but where to now for rates, economic growth and asset values? Our latest forecasts for domestic and global markets. As forecast in our March update, the RBA sensibly paused their sequence of rate hikes at 3.6% on Tuesday, but maintained their tightening bias, warning of the possibility of some further tightening of monetary policy ahead. This message left the door open for another hike to 3.85% in May, largely dependent on the quarterly inflation data to be released on April 26. But it's a very different tone to 2 months ago, when they indicated that further increases will be needed in the months ahead. And this diluted statement makes sense in lieu of the latest monthly CPI data. As the chart shows, consumer prices peaked in December at 8.4% and are now below 7%. So, assuming the quarterly data follows a similar path, the RBA can pause rate hikes for some time and monitor this trend. An upside surprise in the quarterly numbers would bring another rate rise back in play. But irrespective, it's now important to keep in mind how long it will take for core inflation to return to the 2 to 3% target, probably a year and a half away. So talk of RBA rate cuts remains premature, in line with an expected soft-ish landing, with rates remaining around this level. In contrast, the US economy remains very likely to enter recession later this year. So no surprises that US markets are now factoring in a lower peak in rates and cuts through year-end. So US rates appear to have peaked at around 5%, and economic data for manufacturing, housing, and the latest fall in job openings supports this view. US CPI, thankfully, is moderating, which is being reflected in bond markets, but not yet in stock markets. From here, while the US, UK, and many European economies are headed for recession, we still expect Australian GDP growth of around 1% this year. Not much, but still positive in real terms. However, unemployment is likely to edge higher as lower consumer demand weighs on business conditions. While RBA rates are near their likely peak, they impact the economy with a lag, so property values, despite a slight uptick in March, are likely to decline another 3 to 6%, depending on the location. This, together with inflationary pressures, will flow through to household spending, although the offsetting factor for local businesses remains the positive consequences of China's reopening and the related rebound in international tourism, student numbers, and demand for our exports. And finally, the Aussie dollar is back around 68 cents, even after the RBA pause in rate hikes. And given our forecasts of outperformance of our economy, albeit against a low benchmark of hard landings elsewhere, we retain our expectation of 70 cents by July and closer to 74 cents by year-end. And that's the market update from Bendigo Bank.